Hey everybody, Mike Manna here for this week's episode of 62 Who Knew. And I want to get to this just very quick. I want to get to our guest. There's no announcements. There's no summary because this topic is just so near and dear to my heart. It's been a topic for years on the 62 Who Knew television show. And of course, it's about long-term care insurance. And we'll discuss the many reasons why it's near and dear to my heart. But we're so happy to have a very well-known national expert, Mr. Keith Bercun, here as a guest. Welcome, Keith.
Mike, good to be back. Always good to see you and spend some time with you.
Absolutely. And thank you. Of course, you were on the TV show several of times,
Yeah.
The 62 New TV show. Let's give our audience just a little background. Keith Bercun joined Crump Insurance in 2025 as a regional director responsible for assisting financial professionals in delivering life insurance, annuities, long-term care, linked benefits, and disability insurance products to fit their clients' needs. He designs and implements estate planning, supplemental retirement, and business insurance cases throughout underwriting and throughout the country. With over 25 years of financial experience, Keith worked as a regional account director for a national hybrid long-term care LTC insurance company. It's going to be one of our topics today. What the hell's a hybrid? But you're going to learn that today. He worked with local and national independent marketing organizations, developed marketing and training programs to drive more LTC business, and assisted financial professionals in identifying opportunities. Keith has also worked as a regional vice president of a national LTC company providing service to brokerage dealer agencies and bank channel accounts, and then transitioned to covering IMOs in the Eastern United States. Welcome to the show.
Great to be here, Mike.
We've done enough business with each other, and you've helped enough of my friends and relatives to know, or for me to know, that this isn't just something you sell. You have a deep tradition. You have a deep loyalty and actually compassion for long-term care insurance. So I remember the answer to this question from a few years ago when you were on the TV show, but I'm going to ask it again because I want our viewers to know what type of person you truly are. What brought you to long-term care insurance?
It's a good question. As most people will get into this either to buy a policy or for those people that have a passion and get into the business, it's because generally you haven't experienced something happens. And very similar, that's what happened with me. I saw this occur with all three of my grandparents. Unfortunately, I never got to meet my grandfather on my mother's side. Died way before I was born. All three of my grandparents went through this, and I got to see firsthand what it looks like when there is a plan in place and how much that unbelievably supports the family, and when there's not a plan in place, and what it does to a family, and how arduous it is, and how much it uproots the harmony within a family. It is not just about money.
No, it's not.
At all. As a matter of fact, when people tell me, we're self-insuring. No, you're not self-insuring. You're self-funding. There's a big difference between paying for it and being prepared and planning for it and insuring for it. People don't insure for it. Generally, they just decide that they're going to pay for it. So I saw, again, really firsthand what this looks like, and got into it many years ago in sales as an agent. Then had a phenomenal opportunity with the first company I was working for at the time, GE Financial, which became Genworth, to join the wholesaling ranks, which I've been doing for the last 25 years, helping financial professionals really understand the impacts of long-term care and how important it is as both fiduciaries and just humanitarians to bring it to their clients and their clients' families. So something I experienced firsthand, and even in my own family. My family and I were in a pretty horrific car accident at the time, my wife and my two kids, and we actually had to bring in long-term care into our own home for about 4 or 5 weeks. So we got to see it and live it firsthand as well. So it's a big deal when it happens, and being able to lean into a plan, a company to help you through what's a really, really hard time is just unparalleled. So that was my entrance into it.
I appreciate you sharing that with us. It's amazing how many, I'll use the word legends in the long-term care insurance business that have been on the 62 Who Knew television show and now the 62 Who Knew podcast. And almost every one of them started with an experience with their parents or grandparents and going, oh my God, what do we do here? We're not prepared. We're not ready. And in some cases, we can't afford. But you're right. The emotional value of this, which I learned through personal experience of being my dad's caretaker, and we didn't have a plan. The plan was, he was the best father in the world, and I'm going to take care of him. And I said that when I was 10 years old, and I said that when I was 15. And then when the time came in my 50s, I was so proud to do it. But I learned the hard way that you need your son or your daughter to take care of you in different ways. You need to be there. You don't necessarily, I'm just going to be blunt, you don't necessarily have to be there, or do they want you to be there to pick them up when they fall down in the shower?
Exactly.
To be more blunt, to wipe their butt or to help them change their sheets. People don't think about that. I didn't. I was just, it's time. This is what I wanted to do my whole life. Take care of my dad. And my mom, we lost way too early to cancer, or my mom. But usually father, son, mother, daughter, sex does have something to do with it. Same sex. I mean, it's hard to think about helping your mom in the bathtub. It's hard to help, or in the bathroom. Man to man, there's no problem. But you know what? Dad didn't like it. He looked at me one day and just said, this isn't right. This is not the way you're supposed to take care of me. Go get somebody to do this kind of stuff. And then tomorrow you and I are going out back for a filet mignon. That's how you're taking care of me.
Exactly.
You're driving me to your son's karate tournament or to Stacy, my daughter's cheerleading tournament. That's how you're going to take care of me in my last couple of years of life. Not this. But we didn't have a plan. We had great insurance. Dad had Medicare supplemental policy, and he was a highly decorated disabled war veteran, World War II, ex-POW. So the VA gave him staggering things. And still, we spent a lot of money to make sure Dad, it didn't even come close to what Dad needed. We should have had long-term care insurance, and that's 20 years ago. And that's when I became addicted to long-term care insurance.
Yeah.
So it's amazing how that happens. So let's talk about long-term care insurance, because like so many other products, it is just misunderstood.
Very much.
It is surrounded by misinformation, half-truths. Well, first of all, it's for the rich. Let's face it. You got to write a huge check, and only the rich can afford long-term care insurance. So I have the passion, but you have the passion and the 25 years experience. Go ahead and tell our audience why that is pure crap, that it's not just the rich that can afford long-term care insurance.
Yeah. I mean, it is definitely, it's a luxury to have in the aspect that you obviously have to be able to afford the premiums. For people that can't, that is what Medicaid is for. Medicaid is a phenomenal federal and local municipal benefit that's there for people when they just don't have the money to pay for their own care, but it's there to be a last resort. What's great is now more than ever, there's never been as many options available for consumers to choose on how to plan for long-term care. It's still not cheap. I mean, you're talking about something that once you hit 65 and older, has a 75% chance of happening as an individual. If you're a couple, there's an 82% chance one of you is going to need long-term care. And, for a male, average length of care is about 2.5 years. Female, average is about 3.7 years. But 1 in 4 people are going to need care for longer than 4 years. And the national median per year cost is about $78,000 to $80,000 a year. So you're talking about something that has a 75 to 82% chance of happening, is very, very expensive, which makes it one of the most expensive insurances to underwrite. So when I started in the industry nearly 30 years ago, there were 150 companies selling traditional long-term care insurance. Mike, you have any idea how many there are right now?
I bet you a lot less, but I won't guess.
6.
Oh, whoa.
6. I mean, and we're not talking fly-by-nights. Companies that are no longer selling long-term care are John Hancock, Allianz, Hartford, Prudential, MetLife, CNA, billion-dollar companies, because it was too hard to insure and the claims were just too great. It is a very, very expensive product for companies to get involved with. So because of that, yes, there's going to be a price associated to it. It is not necessarily an inexpensive insurance, but you can make it affordable, absolutely, in the way that you can design it. And there's all these different ways in which it works now. So you have traditional long-term care insurance, which is very much like your auto insurance or your homeowner's insurance, where it basically just has one function. You pay an annual premium, which can be paid monthly or quarterly. And if you need it for long-term care, it's going to provide you a long-term care benefit, but it has no other added value whatsoever. If you die and never need it, which is unlikely, but if that happens, you get no value whatsoever in the policy. If you ever quit, you want your money back, nothing happens there as well. There's no cash value. And these traditional long-term care policies don't have locked-in premiums. As a matter of fact, most traditional carriers have seen some rate increases just like you get with your homeowner's insurance or your auto insurance, your medical insurance. Those premiums are going up quite a bit over the last 4 or 5 years. And that can with traditional long-term care as well. It's certainly a viable option. It's a little less expensive than the other option. So it certainly does have its place. But the other flavor of insurance right now that the market has really starting to lean towards quite a bit more over the last decade, something called hybrid long-term care or linked benefits. What's great about these solutions is no matter what happens, with your premium dollar coming in, you are guaranteed to get value with your money. And this is why people are leaning towards these types of solutions. They're hybrid because it's not just a long-term care policy. It's a robust long-term care solution combined with either life insurance or an annuity. So you put your money in, and if you need it for long-term care, you're getting a very robust long-term care solution. But if you die and never need it, it's leaving monies to your estate, to your beneficiaries. This is great for people who like to know that no matter what's happening with their premium dollar, they're going to get some value out of it. And the other option is you can quit and surrender your policy and you can get cash value back. So what people seem to be loving about hybrid or linked benefit products is no matter what happens, live, quit, or die, you're always going to get value out of your solution. Not to mention the premiums are locked in. They can never increase in value just because of the nature of the fact that they're either a life insurance or an annuity-based contract. So those are the two types of core products that are available. And there's so many different ways and you could get creatively to fund either of them.
Well, I guess what's interesting to me, and I think the word expensive, it's like so many things over the last 20 to 30 years, the word expensive, when you first think about it is, well, it's too much money. Right. I don't care whether you're talking about a filet mignon versus a quarter pounder or long-term care insurance or anywhere in between. But expensive has become so relative.
Yeah.
When I started doing mortgages, and I can't believe I'm going to say this, but I am, 43 years ago, my God, what were you, in diapers?
I was young.
Your average car payment was, I remember this because I remember looking it up, was $98 a month.
Oh my God.
Do you know what the average car payment is today? I looked this up. It was just about a month ago for one of my speeches that I was giving. For a brand new car, your average car payment in the United States of America is $745 a month.
That's the average. Wow.
Right. Now, that's not a Mercedes or a Beamer or certainly not a Ferrari or a Lambo. It's not even a Corvette. This is your average car. This is your SUV for mom to drive your kids to school in. So when you say expensive, because I've been involved in LTC, long-term care insurance sales, where people were getting, I'm going to have to say, fairly serious coverage.
Yeah.
And their monthly premium was less than their car payment. So this whole idea of expensive, sometimes I think it's a self-fulfilled prophecy by the industry.
Yeah.
My God, I remember, my kids are older now, but when I had 4 cell phones on my bill and 2 Apple Watches and this, my cell phone bill every month was $500
Right.
because I had the kids and the grandkids. Is that too much to pay for $5,000 a month for 15 years for your long-term care insurance. And I'm talking about in benefits. Is that too much for a $200,000 life insurance policy? So I think the industry itself has to get away from it's expensive, because it's not. It's expensive compared to what? A Happy Meal? I'm disagreeing with you, respectfully here. I don't think it's expensive. I think that's a self-fulfilling prophecy by the LTC industry.
I agree with you. It's not that it's expensive. It's just an expense that is for people that can afford it. And unfortunately, when you look at the majority of Americans who have assets and or other income outside of fixed income, it's for those people, which is there's a great deal of Americans that can. But I agree with you, Mike. If people look at this and say it's too expensive, well, then wait a minute. If an annual premium was $5,000, $6,000, $7,000 a year, you find that expensive. The cost for care is $5,000, $6,000, $7,000 a month. How do you not find that expensive? And you're talking about
and unacceptable in your 80s and 90s.
Exactly. And this has a 75% chance or greater of actually happening. So when people that can afford it and have that disposable income say it's expensive, they're doing what I call the Heisman. It's going to happen to me. And they don't understand what's at stake. And more importantly, they're only thinking of it from a funding perspective, and they're really not looking at the emotional aspect of it. When you need long-term care, how is this going to impact my family, my kids, my spouse, who I've always promised I would do everything I can to always protect? And those are the ones that are so impacted when you need long-term care.
You've spent years building equity in your home, and now it's time to let that equity work for you. The fractional sale of your home equity lets you access the cash you need without taking on additional debt. It is a game-changing tool to help fund retirement, cover healthcare costs, or simply enhance your lifestyle. No monthly payments, no interest, just financial freedom. Turn your biggest asset into your greatest retirement ally through the power of fractional home equity. To learn more about this, go to www.62whoknew.com and check on the Chiefs link.
Are you turning 65? Well, if so, the most important decision in your life right now is to determine which Medicare plan you need to be on for your unique changes in life. Are you still working? You on your employer's plan? How about being a snowbird? If so, you need to speak to a Medicare consultant who can help you with your needs. I'm Diane Daniels, and I'm the CEO of Medicare Nation. Go to www.62whoknew.com and click on the Medicare Nation tab. I will give you a free consultation to make sure we find the right plan for your unique needs.
Yeah, and people really, and people don't understand that. And I've grown up, as I've gotten older, you get more cranky and you get your own little picadillos. And one of my picadillos is when anybody starts a sentence, anybody, a doctor, an insurance person, a salesperson, with what you don't understand, I almost tune out to the rest of the sentence, because at my age, I'm not a genius. I'm not going to split an atom anywhere in the near future. I'm definitely not going to cure cancer or anything like that or invent warp speed. But when you get to a certain point in life, you kind of understand a lot of what you're talking about.
Mm-hmm.
But I have to say this because I experienced it. People don't understand the emotional value of long-term care insurance. The ability to have your children, and I'm not going to repeat the story again, but since I went through it, be there for you as your son, as your daughter. That's what you want during those years. And again, people think, oh, you mean when I'm decrepit and laying in bed and I can't move? No. You needed long-term care insurance with your family after a car accident. This is not that insurance. And I think that's another thing that the industry, the long-term care industry, has not done a great job on projecting what this really is. People use this in their 50s, their 60s, their 70s, when they're viable, when they're mobile, when they're playing pickleball, but they need it for a certain amount of time. And then even when they need it for a year, they're still going to the mall. they're still going to watch their kids, and you're there to help them with that. Not necessarily there to help them off the toilet, not necessarily there to help them when they fall down in the shower. And I've learned the hard and emotional way. They don't want you there for that, but they don't think about that in their 50s.
Yeah.
My son's going to take care of me. My daughter's going to. How about the fact that your daughter's leaving her job for 6 months or a year to take care of you? How is that? I mean, we have best-selling authors come on the podcast that talk about the different obstacles that women have in their mid-60s when they're going to retire. And I learned stuff from experts like you, and I listened, and and in today's world, the husband and the wife, they're both making great money. This isn't my parents where mom stayed home to take care of the children. Those were the World War II generation. Mom and dad today are making equal money. It's like a lot of the mortgages and policies I rate, mom's making more money. But when somebody needs help, it's almost always the mom that goes, I'll take care of your mother.
That's correct.
Or our son's got asthma and we need to move to Arizona and he's having problems breathing. I'll take a breath. But now it's 20 years later. Dad has X in his 401k and they're talking about retiring. And mom has a lot less than X. And they look at each other and go, that's weird. We both made about the same amount of money our whole life. Why do I have so much less, the wife is saying, in my retirement account? Well, you took the better part of 5 to 10 years off to take care of your mother-in-law, your father-in-law, your mother, your father, your aging grandmother, and you weren't working. That's why you have. So there is such unique situations, that different parts of the community, especially women, face because of the emotional part of LTC. And it's a hard sell. I hate to say sell, but you do have to sell people this. And it is a hard sell to say to somebody in their 50s, you need to think about this.
Yeah.
You need to think about your children helping you out of the bathtub. Do you really want that? It's a rough one. But let's talk about these hybrid products, the Link products. Many of them are single premium. And people are writing a 6-figure check. And single premium meaning that's it. That's your only premium. You got a policy for life. But there are those type of policies that, correct me if I'm wrong, that can be split over 5 years, 8 years, 10 years, 15 years. You don't have to write that 6-figure check.
Yeah, not only that, there are policies that will even offer a flex annual pay. So they literally, from a premium standpoint, look, feel, smell, and taste just like a traditional long-term care policy where you can pay annual premiums. And those annual premiums can even be broken up into monthly payments. So they are very affordable. So what's great is there's never been a better time right now to either be in the industry, selling it, be a consumer that's looking for and needing it, because literally any way imaginable that you think you might be able to afford and or pay for these premiums, there's a viable option for that. And they're on a variety of different chassis, whether it's life, indexed annuity, fixed annuity, there's universal, whole life. There's so many different ways to do this. And even some of the policies will even let you tap into your qualified money. A lot of Americans have a great deal of their assets loaded into their 401ks. Or their 403bs or their IRAs. One particular carrier will actually allow you to do a rollover of a lump sum of money out of a 401k or an IRA. You use that money, they bonus it, so it offsets any taxation that you're using to pull that money out, and that'll fund a beautiful linked benefit solution, Life with Long-Term Care. So there's all these different ways. Even the government.
That's incredible.
Yeah, it's a phenomenal solution. Even the government got involved in helping and assisting in the proliferation of seeing more leaning towards privatizing long-term care with hybrid solutions. They came out with something called the Pension Protection Act, and that did a great many things. But one of the things it allowed for was the creation of Pension Protection Act annuities. So there's I think there's about $250 billion sitting in annuities right now that are out of surrender. So they're just sitting there collecting.
Explain that to our consumers, out of surrender.
Sure.
Tell
Sure. So an annuity is basically a savings account. Imagine putting money in a bank account. An annuity is just an account sitting with an insurance company or an annuity company. And you put your money in, um, and it will stay invested over a certain period of time where you can't pull that money back without having a penalty. So most annuities, for example, have like a 9-year surrender charge. You put in $100,000, it's going to grow with interest based on an interest rate or based on investing it into an index. And you put in your 100 grand. And if you ever want your money back, the first year you can get it back, but there'll be a 9% penalty on that. The second year, it would be an 8% penalty. It decreases until after 9 years, and that's just standard. There's no more surrender. So there's a lot of annuities. People have bought annuities generally when they're trying to accrue interest on their money and not pay tax on it. What's great about annuities is they're tax deferred. You could put $100,000 in. 20 years down the road, your 100,000 is now worth 3 or 400 grand. And all of that gain that you were getting while that annuity was growing, you weren't paying tax. It's tax deferred. You're not paying tax while it's accruing, while it's growing, but it's not tax free. Government's always going to get their hands on your gains and your money. So if you do ever start using that annuity for income, a lot of people bought annuities because it was a great way to put money in, watch it grow over time. But then in retirement, that was supposed to be a nest egg that people can use to pull on and help offset bills after you retired and not getting income anymore. The problem is you're going to pay tax on all the gains once you actually use it.
Just the gains, though.
Just
Not that original. So there's 300,000 in that account. You put in 100 G's.
correct.
100 of it is not taxable because that's your money. You pay taxes on that when you put it in. The profit is taxable.
Exactly. But what the government found, the government did a Gallup poll and found that over 85% of people that bought these tax deferred annuities were never turning them on. They weren't using them. They bought them. They ended up not needing them. Why weren't people using them? What do people hate more than anything in the world? Paying taxes. So these annuities were sitting there, and they're terrible products to die with because that money, that $100,000 annuity that grew to 400,000 will pass down to beneficiaries, and all those gains are now taxable once inherited by beneficiaries. So the government allowed for the creation of Pension Protection Act annuities, which was a part of the Pension Protection Act. And there's about 3 or 4 companies that actually jumped on it only. So what's a Pension Protection Act annuity? A Pension Protection Act annuity is an annuity that can take money from an existing annuity with a whole lot of gain. You can roll that existing annuity into the Pension Protection Act annuity, and it will take all of that taxable gain and make it 100% tax-free if it's used for long-term care. But
That's amazing.
it's amazing, and that's just the icing on the cake. Several of the carriers offer triplers and quadruplers. We actually just did this for one of your clients, where you could take 200 grand day one, turn that into 600 grand, 100% tax free. But the real beautiful stories are when you got a client or a consumer that's sitting on annuity worth 200 grand and 100,000 of that is taxable gain. And you can bring the whole 200,000 over with 100,000 that was once taxable, and we'll turn that 200 grand into 600,000 overnight. And the whole thing is tax free if it's used for long-term care. Well, these are just some of the exciting things that you can do with hybrid or linked benefit solutions, the Pension Protection Act annuities, the ability to use qualified money. What's so great is it's a really interesting time for financial advisors and insurance agents to get involved with this, because you could get really creative when working with people and looking at where their money is. A lot of times, what I tell people very often, when you're getting involved with a hybrid or linked benefit solution, you're not buying anything. You're really just moving money from your left pocket
That's right.
over to your right pocket, because you maintain the value in it. If you quit, you want your money back. In some scenarios with some policies, you get 100% of your money back. You die, you don't need it. You're going to make more by passing on a death benefit in your estate. But if you need it for long-term care, where there's greater than a 75% chance that'll happen, you're going to get massive value on your money tax-free for long-term care. It's the live, quit, or die solution that no matter what, you're getting value out of your money. It's like you're not buying anything. You're just moving it around to another pocket
Yeah.
that you own.
Well, you're moving it to the other. And when you add in those two magic words, tax-free,
Yeah.
you're real. I mean, if you're blessed enough to have assets when you need it, again, I can't stand when people say, well, we're going to self-insure. Like you said, you're going to self-fund. You're not self-insuring. And I hate when financial planners, and I have enough financial planner friends, and we have enough on the show that I know they don't like when I say this, when they say to their clients, oh, you have enough in investments, you can self-insure. No, I've always said, and this is a different topic that we'll talk about, are they breaking their fiduciary obligation by looking at a client and going, look, you've worked your whole life, you have millions of dollars. If you need a few $100,000 for long-term care, you got it. Is that really good advice when there could be a hedge in place that turns that into tax-free money? Or is there one eye on their AUM? Oh, I'm going to make enemies over this, which is their assets under management, and they don't want you to take money out of their portfolio to buy a long-term care insurance policy, even though that's the proper decision for you and your children.
Yeah, it's a great question that has gone through a lot of debate in the financial planning world, especially amongst RIAs and registered reps. They do have a fiduciary responsibility, and you've seen there's been a lot of lawsuits. There are a lot of attorneys that are making a living doing nothing but going after financial advisors that have their insurance license, and the kids are inheriting their parents' estate that have just been reduced by 40, 50, 60, 80%. Because that financial advisor did not offer a long-term care solution to their clients when it's something that they are licensed to sell. So one of the things that I always encourage a financial advisor or registered rep to do is offer long-term care to every one of your clients. And for those that don't have the wherewithal or the forward thinking to say, yes, you need to have them sign a waiver saying, my financial advisor presented long-term care to me and I'm declining it. And that is a CYA, because when the kids come back and say, we just spent $300,000 on care for mom, why didn't you put them into a policy? Well, I've got the waiver right here. I did offer it to them. I can't encourage that enough. If you're a financial advisor and you're managing your clients' money, get that waiver signed and offer it to all of your clients.
And also, besides the possible conflict of not wanting them to take money out of the portfolio, I think there's also a certain amount of pride involved here because let's face it, long-term care insurance changes so often. It's a high expertise. I think I know a lot about it, but every time I talk to you or other people like you in your profession, I learn more. I mean, this Pension Protection Act is just killing me. I got to ask you about that in a second. But, financial planners are great at what they do. A lot of them specialize in stocks, bonds, municipals, indexed annuities, but maybe they're not great at long-term care insurance. Maybe they don't know every option available like Keith Bercun does. So partner with a long-term care insurance expert. Give your client what they need. Maybe you don't make 100% of the commission, you make a piece, but protect your client. And I think the great majority of financial planners out there would do that. They would go, you know what? I want to cover my ass, but I also want to do what's right for the client. And I don't know enough about this. And I'm 52 years old, or I'm 53 years old, or I'm 48, or a lot of financial planners are 68 or 2. And I'm at a point in life where I'm not sure I'm going to become an expert on the very different products of long-term care. I can't say it enough to our financial planner listeners or to our listeners that have financial planners. Get an expert like a Keith Bercun to work with your financial planner. Nothing wrong with having a team. I mean, when there's something wrong with you at your doctor's office, that doctor brings in other doctors. You have a team. I think people need a team when it comes to financial planning. But let's get back to this Pension Protection Act, because this is killing me. How many millions, if not tens of millions, it's got to be tens of millions of people in their 40s or 50s that long-term care insurance is the last thing on their mind. But they've been on their job an X amount of time. They have an IRA. or K, and a little piece comes out of their paycheck, and hopefully they're with an employer that's doing some sort of matching. And we have become a 401k IRA country. I mean, most big companies don't even have pensions anymore unless you're a school teacher or a cop or a fireman. Let's face it, most big companies aren't giving pensions anymore in this country.
Yeah, no, they're
They
not.
haven't in decades. We're a 401k kind of country. And people going, yeah, if I go the way I'm going, and when I'm 65, there's going to be 412,000 in my 401k. And granted, now I'm 55 and there's half that or less than half that. You're telling me there's a plan in place where they can take that qualified money, turn it into, I might be saying the wrong word, so you correct me, just interrupt me, into some sort of annuity / linked long-term care product that is going to give them a multiple of that money in long-term care insurance, is going, since it's a single premium product, is going to give them a death benefit from day one that is more than they're taking out. So they're ahead of the game day one. And yes, there are tax consequences because the money went in tax-free, but you're taking it out, so you got to pay taxes on your gains. But there are long-term care insurance carriers that are giving an upfront bonus to help make up for that tax penalty.
Yeah, there's one.
Did I say that right?
Mike, actually, I'm pretty blown away because you literally nailed it. There's one carrier that is working with qualified money. It's and I say it's a big part of what they do. They have a lot of different ways that they'll take funding, but it's certainly a niche faction of their business. And you pretty much nailed it. They'll take existing 401ks or IRAs. And granted, if it's a 401k, generally it'll be someone that's been retired. Some companies will allow for what's called an in-service distribution, meaning if you're in your 50s and you're still working. Some carriers, companies, like if you're working for ABC organization and you have your 401k there, a lot of times they won't let you pull money out of your 401k while you're working. That's called an in-service distribution. But a lot of people have
I didn't know that.
and most people who are looking at getting into this are in their mid 50s, so they're nearing retirement anyway. But yeah, you could pull money out of a 401k or an IRA, and you're basically rolling a lump sum out of it. You're taking one lump sum out of your 401k or IRA, and it's going into an IRA that is set up at this long-term care hybrid insurance company. So they set up an IRA in your name, and in that IRA is sitting an annuity. And they'll give the money that you rolled over. So let's say you have a 401k sitting with ABC company that you worked for 25 years, and you got 600 grand sitting in this 401k. You can roll over 100 grand out of that. And that'll go over into an IRA at this insurance company. In that IRA is an annuity. Now, what's really neat is the first function of that annuity is to give the money that you rolled over a 25% immediate earned income bonus. So you brought over 100 grand, you went from a 401k to an IRA. So you're going from a qualified account to another qualified account. There's no tax there in doing that. You can always go from a 401k to an IRA or another IRA to another IRA. You're staying qualified, so there's no taxable event. So we rolled over 100 grand to the IRA at the insurance company. It goes into an annuity, gives the money a 25% bonus. So in this example, on 100 grand, that's another $25,000 that the insurance company is giving you. So now you're sitting on $125,000 in this IRA, in this annuity. And what they're doing very cleverly is now using this $125,000 to make 10 equal payments into what they call a hybrid life LTC policy. So in that example, 125,000, they'd pull out 12,500 every year over 10 years and fund a 10 pay. And that'll, depending upon your age, give you a death benefit on 100 grand, probably give you a death benefit of like 160, 170 grand. You could use that for long-term care. And what's very interesting with this one particular carrier is they have unlimited lifetime benefits. So when you need this for long-term care, you can get $5,000, $6,000, $7,000 a month as your long-term care benefit, and it never runs out. So you have unlimited long-term care. You never run out. If you die, you don't need it. You have a death benefit. And at the end or at any point, if you decide you want to quit the policy, you still have cash value. And here you are accessing your qualified taxable money, turning this into a tax-free death benefit, a tax-free long-term care benefit. Let me say though, the 10 years that you're pulling money out of the IRA to fund the 10-pay policy, that money you're pulling out every year is taxable. So in that example, the 12,500 that's coming out, you're going to get taxed on that. But remember, the company gave you $25,000 and your 100 grand, it offsets the taxation. And for clients that are north of 73, it'll even satisfy the required minimum distribution. So there's a lot of really unique funding things that you could do now in the marketplace, working with qualified money, working with taxable annuities that have gains that you can turn into tax-free. I mean, these are the things that as advisors, you get to have a lot of fun in planning around with your clients and look very smart. And Mike, you had a great suggestion. By far, of all the different solutions, life, annuity, long-term care is the most complicated. As a matter of fact, there's a funny running joke in the industry. What's the difference between a used car salesman and a long-term care salesman? A used car salesman knows when he's lying. So it's a complicated set of products to work with. So I can't urge enough to partner with a long-term care specialist to work with and help you in designing these solutions, especially if you're a financial advisor. Mike, you hit it on the head. As a financial planner, you're really the quarterback. And as a quarterback, you put a good team around you that you're going to delegate and work with, everyone having their very distinct specialties. So it's not a bad idea to team up with an LTC specialist to bring these solutions to your clients.
No, it's a great idea. I still like, you're looking out for the health of your retirement. And I still bring it back to the doctor analogy.
Yeah.
You go to a doctor and God forbid they find a lump or whatever, you have asthma, whatever. Hopefully it's nothing serious. But the first thing they do is they bring in a specialist. The doctor goes, okay, I'm your practitioner. I'm your family doctor, but we found a little lump on your chest, or for some reason, there's something wrong with your right leg. We're going to go see this, or there's something wrong with your foot. We got to go to they bring in a team for your health.
Yeah.
People have to start looking at this. And this fits in so well to what we do here at 62 Who Knew. It's, that double-edged sword of longer lifespans. It's so great that we got a 50-50 chance of making it to 90 years old. Isn't that incredible? Not if we're suffering and we don't have what we need in those 70s, 80s, and 90s. No, then it's not incredible. Then it really is that double-edged sword.
Yeah.
What's the biggest threat to your retirement savings? It's not the stock market. It's the cost of long-term care. Home care, assisted living, or nursing facilities can drain your life savings in just a few short years. That's why long-term care insurance isn't a luxury. It's a necessity. It protects your assets, preserves your independence, and gives your family peace of mind. Don't leave your future to chance. Plan ahead. Protect what you've worked a lifetime to build with long-term care insurance. For more information, go to www.62whoknew.com and click on the long-term care insurance link. Planning for retirement? Your home can be your greatest financial resource. At 62whoknew.com, our mortgage link connects you to expert guidance on reverse mortgages, refinances, traditional home loans, all designed with retirement in mind. Whether you want to eliminate your mortgage payment, do debt consolidation loans, or downsize with confidence, we help you choose the right mortgage for your future. Visit the mortgage link at 62whoknew.com because the right mortgage strategy today can mean a more secure tomorrow. Why hasn't America accepted this? And I bring this up to my reverse mortgage friends, because you know how I'm addicted to reverse mortgages, but the reverse mortgage industry has done such a terrible job on showing America the right way to use this. Your average person, you bring up reverse mortgages, it's like It's like a scene out of The Exorcist with Linda Blair. The head starts spinning around and green pea soup comes out. Reverse mortgages, no. And again, I don't blame the product. I blame the industry. And I sort of have the same kind of opinion about long-term care insurance. I mean, when I bring up long-term care insurance to people, I have to sell them on it. I am only 50 years old. Why am I thinking about this? What if I don't need it? My daughter can take care of me. All sound good, but I've been hearing that for 20 years. When is the industry itself going to start delivering the right message? Is it because, let's face it, you don't see commercials for long-term care insurance. You see commercials for life insurance, car insurance. You see commercials for everything. I don't remember ever seeing somebody going, do you have long-term care insurance?
Yeah, there's not.
Do you know? Is it that? Is it the fact that there's no national push for the country to have this? That it's up to individuals like us to talk to people about it? And again, why isn't a national insurance company that has a balance statement, and I know I'm asking unfair questions, but their balance statement is equal to the government's budget, because nobody has more money than the insurance industry, not the banking industry, not anybody. You guys have all the money in the world. Why aren't they doing some sort of a national push to protect America? Not to be philanthropic, but to sell more product at least. Yet you don't see that.
No.
What's your opinion on that?
In my opinion, I think you kind of touched on it. It's the type of solution, the type of product that really has to be driven home by someone who understands it and has the passion to deliver it. It's not something I think that is really sold direct to consumer, meaning the insurance companies themselves delivering messages to consumers, expecting sales back in or driving the message. This is a product that is really driven by an agent that has a stake in it because they believe in it, generally because something happened to them and they experienced it firsthand and has a passion for it. It is truly an emotional sale. And I think one of the biggest issues is agents aren't really being trained on how to have the conversation and how to position it. It's not just about understanding the products. I don't think ever in my 25-year wholesaling history have I done a presentation with either of the two carriers that I've worked with where I just strictly dumped product on my audience. I always spent the first 10 to 15 minutes speaking with the agents and advisors that I'm working with, how to have the conversation with their clients, how to bring it up, what's really moving the needle. And I'll tell you, it's really two questions. Two questions bring it home. The first being, when an agent speaking to a client, look, Mr. and Mrs. Jones, I don't know if you'll ever need long-term care, but God forbid if you did, have you considered the impact it's going to have on your family, your spouse, your kids who have jobs and kids of their own and homework and soccer practice? Because these are the people you swore your whole life that you would always protect. And they're the ones that are impacted the most when you need long-term care. Have you considered the impact it's going to have on your family? And that's the first question. Not, you like the idea of you putting up $1 and we're going to give you $4 for that, because that's basically what you're getting. The value prop is insane. The first question is, let's do the right thing so we can protect your family. And the second question is, if and when you need long-term care, how are you going to pay for it? Do you have a plan in place? Have you thought about that? Where are you going to get the money to cover the cost of another $70,000, $80,000 a year? Where's that going to come from? And it is honestly just asking those two simple questions. And it's good to have the percentages and the statistics that I was talking about. 75% chance as an individual you'll need long-term care, 82% chance when you're a couple, one of you will need it. The length of care for a male and female, the averages, the cost. Those are good numbers to later during the conversations when you're designing a policy and to further drill down the fact and bring it in. It's not bad to have those statistics and percentages in your pocket. But the real way to sell this is by asking those two questions. Have you thought what this is going to do to your family? Do you have a plan in place? And when you need this, how are you going to pay for it? Have you considered how much this costs and what this can do to your financial portfolio? And most agents and advisors don't have a clue on how to have the conversation with their clients and how to present it. And it all starts with that.
And you know, the other problem that works against us, when I say us, the long-term care insurance world, is the new world that we live in that is so impersonal, highly technologized, Teams, Zoom, you know, there's nobody that you can sit at their dining room table with and do what you do without them going, oh my God, I've never thought about it that way.
Yeah.
It's the personal touch.
Yeah.
But now we live in a world where people are buying multi-million-dollar houses online. They're getting all their insurance online. They don't go to their favorite store anymore. They go to Amazon. I do. Okay. The movie industry, you know, is going out of business because everybody has a 90-inch TV and they can watch their movies at home and not pay $412 for a box of popcorn. Everything has become so impersonal in this world. And now we add in artificial intelligence. My God, I'm being told there's places in this country, I think California was the first one, where we have robots taking care of people, performing long-term care, performing things. I mean, so the fact that this does need the personal touch, which I agree with you, but we live in a world that's taking away the personal touch from everything.
Yeah.
Want to find a good woman? Go online. You want to find a good car? Go online. You need an air conditioner for your house? Go online. There is no exception. And especially with insurance, I mean, let's face it, the big insurance companies are literally or have literally closed down their independence. Do you drive? I remember driving down the road years ago and seeing the shingles out Nationwide, State Farm, you saw those. I had friends that owned those type of franchises. You don't see that anymore. Well, those major companies bought those people out because they want people to go online and buy it. I mean, more people know about the caveman, from Geico than they knew about anything else.
Yeah.
So this is a personal thing, but we got to figure out a way, whether it's through a podcast or whatever, to meet that in between of getting to your living room table or your dining room table to discuss this and doing it like we're doing right now, because we don't live in a personal world anymore. We live in, a technical world.
I cannot agree with you more. You have complete sales forces that have been replaced in a variety of different industries with AI chat sales agents. It is absolutely insane. Thankfully, what we're still seeing in this industry, at least with the carriers and the organization I'm working for now, the majority, if not all of the sales are still being delivered by financial advisors and or insurance agents. They're complicated. There's a lot to negotiate and navigate through when working with someone, and especially people who have a diverse financial portfolio. There's so many different ways that you can work with a portfolio to fund policies like this, that it takes some good critical thinking sometimes. So thankfully, this has not yet been replaced by AI, as many things are. Let's hope that doesn't change. I will say, though, we are using AI to help with sourcing a variety of things around this, which is great because it is a phenomenal tool. But nothing beats a well-versed, specialized agent that can sit down with your client and look at them holistically and put them in a solution that meets their needs.
No doubt about it. No doubt about it. It's a fine line. This technological, I sound so old when I say this. The technology that we have today has so many advantages, but it does take away the personal touch.
It does.
It just does. And this is a very face-to-face emotional sale. Again, thinking about your daughter, your son helping you in need. There's nothing more personal than that, but it is what it is. Well, as always, we thank you for being here. We invite all our 62 Who Knew viewers, if you'd like to talk to an expert, go to www.62whoknew.com. Go to the long-term care insurance link click, fill out that documentation. You're under no obligation whatsoever to do anything. No super salesman's going to call you 27 times unless you actually request it. But learn more about this. And also remember, to our financial planners that watch the show and our consumers, you're in your 50s. You have a ton of equity in your house, but you literally don't have that ability to write a six-figure check. You know what? Even taking that six-figure check and dividing it over 10 years and paying $600 a month or $700 a month, you have two kids in high school, one starting college, and a daughter that's getting married, and you're paying for their wedding. You may not have that either, yet you and your wife make good money. You're six figures. You're an 800 credit score. You're in your 50s. You know you need this product, and you want to get it now while you're young and healthy. Now's the time to get it. But I just can't write that check. It's amazing how many options you have. That's another thing that's not pushed enough. Yes, you can get a HELOC, a home equity line of credit. Years ago, people went, that's crazy. Why would you fund something with that? It's not crazy when you're putting it into an annuity that's giving you 3 to 4 times more than what you're funding in tax-free. There is a reverse mortgage if you're 62 and above to take equity out of your house and put it into an annuity-related or linked product. And then there's the newest product that is out there that is also a national sponsor of the 62 Who Knew podcast. And please go to www.62whoknew and check on the Chiefs link, because people can borrow, people can sell. I shouldn't have said borrow, bad host. People can sell a fractional part of the equity of their house. And when I say that, a lot of professionals go, I just had a presentation on this at noon today. Incredible financial planner. And when I brought up the fractional sale of the equity in someone's home, you could see on that's what I love about Zoom and Teams. You could sat back in his chair and went, what? I said, why are you surprised at that? Every day, every minute of the day, people are calling their stockbroker. People are going online to their TD Ameritrade account, and they're going, I need 10 grand. I need 3 grand. I need 100 grand. And they're selling a portion of their assets. They're going onto their Coinbase account and they're selling some Bitcoin because they have a need for money, or Ethereum right now. Yet we never think of selling a fractional portion of the equity in our home. And truthfully, with inflation bringing our home values up so much, I mean, you didn't work for that money. I mean, I have friends, and personally, that paid X for their house years ago. It's now worth twice as much, 3 times as much. You didn't work for that. Inflation did that. And isn't it great? I have $800,000 in equity. What are you doing with it? Well, do you have a lot of money put away for retirement? No. Do you have long-term care insurance? No. Do you have any annuities that maybe now in your 50s and your 70s are going to be worth double or triple what they were? No. Oh, but you have $800,000 in equity in your house. Use it. Use some of it. Use a fractional point of it. Our most widely watched episode in the history of the podcast was when Chiefs was on talking about it. Caused a lot of questions. What? What did he say? What do you mean sell 10% of my house? That's absurd. Why? You just sold 10% of your portfolio. You just sold 10% of your Bitcoin. Why? It's one of those new ideas that has to be explained face to face. But there's so much new stuff out there. And if our consumers, at least our 62 Who Knew viewers, don't avail themselves to that, the majority of this country can afford long-term care insurance. You have options. I'm looking in the camera now. I'm talking to our viewers. No matter what you've been told, yes, there is a plan for you to have long-term care insurance and protect yourselves and your children from all the things that happen at that point in your life. So on that note, thank you so much for being here. And To our 62 new viewers, we have some incredible shows coming in the next 4 to 6 weeks. Thank you for being a part of our ever-growing audience, and we'll see you next week. Take care.
Thanks, Mike.